There is a ghost that haunts every investor. It's a cold feeling that begins in the pit of your stomach when the numbers on the screen turn from green to red. It's a quiet whisper that grows into a deafening roar as the market tumbles, telling you to run, to sell, to get out before you lose everything. This ghost is fear. And for 99% of people who try to build wealth in the stock market, this ghost is the executioner of their financial dreams. They listen to its whispers. They obey its commands. They sell in a panic at the absolute bottom, locking in devastating losses. Then, months or years later, when the ghost is gone and replaced by the siren song of euphoria, they buy back in at the top, fueled by a fear of missing out, setting themselves up for the next slaughter. This cycle, this emotional whipsaw, is the single greatest destroyer of wealth in the modern world. But what if I told you there's a man who, instead of fearing this ghost, invites it in for coffee? A man who hears the roar of panic not as a threat, but as a dinner bell. His name is Warren Buffett, and he has spent over 70 years turning widespread financial terror into personal, generational wealth. He didn't do it with a complex algorithm or a secret source of information. He did it with a simple story, a mental model so powerful it can rewire the human brain to conquer financial fear and turn the market's greatest weakness, its emotional instability, into your greatest strength. This story is the final promise that can transform you from a pawn in the market's game to its master. It's the allegory of Mr. Market, and internalizing it is the most crucial step you will ever take on your journey to financial freedom. By the end of our time together, you will no longer see a stock market crash as a crisis. You will see it as a sale. You will learn to stop reacting emotionally to volatility and start acting rationally as a business owner, using market downturns as the incredible buying opportunities they truly are. This isn't just financial education, it's a fundamental shift in your trading mindset, a lesson in behavioral finance that separates the amateur retail investor from the professional wealth builder. This is the blueprint for beating the market. Our journey begins not with a number, but with a person. Not a real person, but an imaginary one who holds the key to unlocking trillions of dollars in value. His name is Mr. Market, and he was born in the mind of Benjamin Graham, the father of value investing, and the man who shaped Warren Buffett's entire worldview. To understand the immense power of this idea, we must first travel back in time, not to a frantic trading floor, but to the quiet, cerebral world of a young Buffett at Columbia University in the early 1950s. He had come to Columbia for one reason: to learn from Graham. Buffett had already been investing for years, devouring every book on the subject he could find, but reading Graham's masterwork, The Intelligent Investor, was a lightning bolt. It was like a religious conversion. For the first time, someone had laid out a logical, systematic framework for investing that treated it not as speculation or gambling, but as a business discipline. At the heart of that book, in Chapter 8, was Graham's simple, brilliant parable. He asks you to imagine that you own a small share in a private business. One of your partners is a fellow named Mr. Market. He is a very obliging partner. Every single day, without fail, he comes to you and tells you what he thinks your shares are worth, and he offers to either buy you out or sell you more of his shares at that price. But Mr. Market has a problem. He is a manic depressive. Some days, he shows up in a state of wild euphoria. He sees nothing but a golden future for the business, and he quotes you a ridiculously high price for your shares. On other days, he is inconsolable. He is consumed by pessimism, convinced the business and the world are heading for ruin, and he offers to sell you his shares at a price so low it's absurd. Graham's punchline, the idea that would lodge itself in Buffett's brain and guide Berkshire Hathaway for the next 7 decades, was this: the choice is always yours. You are free to ignore him completely. You don't have to trade with him just because he shows up. He will be back tomorrow with a new price. You should only engage with him when his mood serves your interests. You should happily sell to him when he's euphoric and offering you a crazy high price, and you should gratefully buy from him when he's despondent and offering you a bargain. You should never, ever let his mood dictate your own. For the young Buffett, this was not just a clever analogy, It was the Rosetta Stone of market psychology. It provided a perfect mental buffer between the chaotic noise of the stock market and the rational mind of the investor. The stock market, with its flashing tickers and breathless commentators, was no longer an all-knowing oracle dictating the value of his holdings. It was just Mr. Market, his moody, unreliable but ultimately harmless business partner. This single shift in perspective is the foundation of all successful long-term investing. It's what allows a true investor to remain calm and analytical while the world around them is losing its mind. It's the armor that protects you from the two great wealth-destroying emotions, fear and greed. The genius of the Mr. Market allegory lies in how it hijacks our own cognitive wiring. The psychological principle at play is a powerful one known as anthropomorphism, our innate tendency to attribute human traits, emotions, and intentions to non-human entities. We do this all the time. We get angry at our computer when it freezes. We talk to our pets as if they understand us. We name our cars. Benjamin Graham masterfully weaponized this tendency for our own financial benefit. By giving the market a name, a personality, and a psychological condition, manic depression, he transformed it from an abstract, terrifying, and impersonal force into a concrete character. This is a crucial mental leap. It's incredibly difficult to have a rational relationship with an abstract concept like the market. When the market crashes, it feels like an overwhelming, objective judgment on your decisions. It feels like the world is telling you that you are wrong, that you are losing, that you are a fool. This triggers our deepest survival instincts, our fight-or-flight response. And in the world of investing, flight means selling. But it's much easier to have a rational relationship with a person, even a fictional one. When your emotionally unstable business partner, Mr. Market, shows up crying and screaming that the world is ending, you don't automatically assume he's right. You might feel a little pity for him, you might be amused, but you can look at him objectively and say, poor Mr. Market is in one of his dark moods again. He's letting his emotions get the better of him. The business is actually fine. This reframing creates a critical psychological distance. It externalizes the volatility. The market's movement is no longer a reflection of your intelligence. It's a reflection of Mr. Market's emotional state. This ties into another powerful concept, the framing effect. This cognitive bias demonstrates that our decisions are profoundly influenced by how information is presented to us. If I tell you a medical procedure has a 90% survival rate, you feel confident. If I tell you the exact same procedure has a 10% mortality rate, you feel fear. The data is identical, but the frame changes everything. The 99% of investors operate within the market as oracle frame. In this frame, every price movement is a piece of vital new information, a judgment from a higher power. A falling price means the oracle is displeased, and you must act. A rising price means the oracle is smiling, and you must chase it. The Mr. Market allegory shatters this frame and replaces it with the market as manic depressive partner frame. In this new frame, the price movements are not new information about the business. They are new information about your partner's mood. This simple shift in framing diffuses the emotional power of volatility. The price quote is no longer a command. It is merely an offer. And you, as the rational business owner, are always in the position of power, free to accept, reject, or ignore that offer based on your own analysis, not on your partner's hysteria. This is the essence of a sound trading mindset and the bedrock of behavioral finance. So how do we take this brilliant parable and turn it into a daily practice? We need to translate the theory into a practical, applied mental model. Let's call it the Mr. Market Daily Check-in. This is a step-by-step process you can use every single time you interact with the market, transforming a potentially emotional and reactive habit into a disciplined and proactive one. Step 1. Acknowledge the arrival. When you open your brokerage account or check stock prices, consciously visualize Mr. Market knocking on your door. He's here for his daily visit. This act of personification immediately puts you in the right mindset. You are not plugging into the matrix. You are greeting a business partner. Step 2. Diagnose his mood. Look at the direction and velocity of the market's movement. Is everything deep in the red? Are the financial news headlines screaming about a bloodbath or a stock market crash? That's Mr. Market in a deep, clinical depression. Is everything rocketing upwards? Is there talk of a new paradigm and pundits are predicting endless growth? That's Mr. Market in a state of pure mania. Is the market more or less flat? He's having a rare moment of lucidity. The key is to label his emotional state before you even look at your own portfolio's value. This separates his feelings from yours. Step 3. Consult your own ledger. This is the most important step. Before you ever consider Mr. Market's offer, you must know what you believe the business is worth. This is your calculated intrinsic value. For any serious retail investor aiming for financial freedom, this is non-negotiable. You must have done the work beforehand to determine a fair price for the companies you own or wish to own. This number, calculated by you in a state of calm rationality, is your anchor to reality. Without it, you are lost at sea, at the complete mercy of Mr. Market's emotional tides. Step 4. Make a rational decision. Now, you compare Mr. Market's offer to your own valuation. If he is in a deep depression and is offering to sell you shares in a wonderful company for 50 cents on the dollar compared to your calculated value, you should seriously consider buying. This is the very definition of a buying opportunity. If he is euphoric and offering to buy your shares for twice what you think they are worth, you might consider selling. And if his price is somewhere in the middle, in the range of what you consider fair value, you do the most powerful thing an investor can do: nothing. Step 5. Politely dismiss him. Regardless of your decision, whether you bought, sold, or did nothing, the final step is the same. You mentally thank Mr. Market for his quote and tell him you'll see him tomorrow. You close the app, shut the laptop, and get on with your life. You do not let his mood, whether it was good or bad, infect your own day. This 5-step process, practiced daily, builds an unbreakable mental fortress. It turns a source of anxiety into a source of opportunity. This is the investing strategy that allows you to systematically take advantage of the market's psychological flaws instead of being a victim of them. It is the practical application of value investing at its purest. To truly appreciate the power of this framework, we must examine its opposite. We must walk the path of the 99%, the path that leads to financial ruin. This is the path of ticker tape hypnosis. The average retail investor does not see Mr. Market. They see the market as a divine, all-knowing entity, an oracle. The ticker tape, that endless stream of green and red numbers, is its voice, and they are utterly hypnotized by it. Their emotional state is directly tethered to the direction of the S&P 500. When the market is up, they feel smart, validated, and euphoric. When the market is down, they feel foolish, anxious, and terrified. They have completely fused their self-worth with the daily fluctuations of their portfolio. This hypnosis is fed by a constant IV drip of financial media. They wake up and turn on CNBC. They have push notifications from their brokerage app turned on. They listen to so-called gurus who claim to know where the market is going next. This fire hose of noise and opinion serves only to amplify their emotional reactions. Let's imagine a typical scenario. An investor, let's call him Tom, owns shares in a fantastic world-class company. He bought it for good reasons. But one morning, he wakes up to see the market is down 3%. A headline flashes across his phone: "Fears of inflation rattle markets." The ghost of fear begins to whisper. His $10,000 position is now worth $9,700. He feels a knot in his stomach. The next day, it's down another 4%. His position is now worth less than $9,400. The oracle is clearly displeased. The whispers get louder. "This could be the big one," they say. "You need to protect your capital. Tom's rational brain, which knows he owns a great business, is being hijacked by his amygdala, the primitive part of his brain responsible for the fight-or-flight response. He sees his friends on social media panicking. He hears a pundit on TV say, "There's more pain to come." The social proof and the voice of authority overwhelm him. He capitulates. He sells everything just to stop the bleeding. He feels a moment of relief. The pain is gone. But what has he actually done? He has allowed the temporary mood of millions of strangers to bully him into selling his share of a wonderful business at a discount. He has turned a temporary paper loss into a permanent, real-world loss of capital. This is the path of the 99%. They treat the market like a god to be appeased, rather than a servant to be commanded. They are reactive, not proactive. They are emotional, not analytical. They are playing a game that is rigged against them from the start, a game of psychological warfare for which they have no defense. The financial consequences of these two opposing mindsets are not small, they are monumental. They are the difference between a life of financial struggle and one of financial freedom. Let's quantify the impact. When you internalize the Mr. Market mental model, your primary financial achievement is the prevention of catastrophic value destruction. Imagine a fundamentally sound portfolio worth $100,000. A stock market crash occurs, and Mr. Market, in his deepest depression, marks down the value of your holdings by 30%. Your screen now reads $70,000. The investor on the path of the 99%, gripped by ticker tape hypnosis, sells. They have just locked in a $30,000 loss. They have permanently destroyed 30% of their capital. To get back to their starting point of $100,000, their remaining $70,000 now needs to generate a gain of over 42%. They have put themselves in an enormous financial hole. You, the practitioner of the Mr. Market mindset, do nothing. You see the $70,000 number not as a loss but as a temporary, ridiculous offer from a depressed business partner. By simply ignoring him, you preserve your ownership stake in those great businesses. When the market inevitably recovers to its previous level, your portfolio returns to $100,000. You have avoided the devastating permanent loss. But this is only half the equation. The true power comes from moving from defense to offense. Let's say you had the foresight to keep some dry powder, some cash on the sidelines for just such an occasion. While the 99% are selling in a panic, you step in and use Mr. Market's depression to your advantage. You deploy an extra $10,000 of cash, buying more shares of those same great businesses at a 30% discount. When the market recovers, your original $70,000 worth of stock goes back to being worth $100,000. But the extra $10,000 you invested now becomes worth over $14, $200. You haven't just weathered the storm. You have used its energy to slingshot yourself forward. This is how wealth is built. It's not about timing the market perfectly. It's about having the psychological fortitude to act rationally when everyone else is acting irrationally. It directly impacts your portfolio growth by allowing you to acquire assets at prices that provide a massive margin of safety and a dramatically higher potential for future returns. Over an investing lifetime of several market cycles, this one skill, the ability to use Mr. Market, not be used by him, can be the difference of millions of dollars. It is the single most important principle in professional wealth management and the key to beating the market over the long run. Having established the foundational mindset of Mr. Market, we must now turn our attention to his most dangerous and profitable mood, his deep, dark depression. This is the state of pure panic, the stock market crash, the moment when the ghost of fear is no longer whispering but screaming in every investor's ear. For most, this is a time of terror. For the prepared investor, it is the single greatest opportunity for wealth creation that exists in a capitalist system. This is the panic principle, the art of weaponizing widespread fear. There is no greater case study in this principle than Warren Buffett's actions during the 2008 global financial crisis. The fall of 2008 was not a normal market downturn. It was a moment of existential dread. Lehman Brothers, a 158-year-old institution, had vaporized. Bear Stearns was gone. AIG, the world's largest insurer, had been bailed out. There was a genuine, palpable fear that the entire global financial system, the ATMs, the credit cards, the banks themselves, was on the verge of collapse. Mr. Market was not just depressed, he was suicidal. The financial world was a burning building, and everyone was stampeding for the exits. And what was Warren Buffett doing? He was calmly walking into the fire with a very large hose full of money. On September 23, 2008, just days after Lehman's collapse, Buffett announced that Berkshire Hathaway was investing $5 billion into Goldman Sachs, one of the epicenters of the crisis. The deal was a masterpiece of opportunism. He didn't just buy common stock. He bought preferred stock that paid him a 10% annual dividend, $500 million a year guaranteed. He also received warrants that gave him the right to buy $5 billion worth of common stock at a fixed price for the next 5 years. He was essentially getting paid handsomely to wait for the inevitable recovery. Less than 2 weeks later, on October 1st, he penned an op-ed in the New York Times titled, "Buy American, I Am." In it, he laid out the Mr. Market thesis for the entire nation. He stated flatly that he was moving his personal cash into U.S. stocks. He wrote, and I quote, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy only when others are fearful." The financial world was aghast. Here was the world's most respected investor, running into the teeth of the worst financial storm in 80 years. A few weeks later, he struck again, investing $3 billion in General Electric. The following year, he would make his most famous crisis-era investment, helping to finance Bank of America's acquisition of Merrill Lynch. In each case, the terms were extraordinary, deals that would be unthinkable in a normal market. Why could he do this? Because in a world drowning in fear, two things become priceless: cash and courage. Buffett had both. He had spent the preceding years of the housing bubble patiently accumulating cash, while others were greedily chasing returns. He saw Mr. Market's euphoria and simply said no thanks. Then, when the panic hit, when Mr. Market was offering him pieces of America's premier financial institutions at fire sale prices, he acted decisively and with immense force. He wasn't catching a falling knife. He was buying world-class, systemically important businesses when their very survival was being questioned, securing terms that would generate billions in profits for Berkshire shareholders for years to come. This is the panic principle in action. It is the art of seeing clarity amidst chaos and having the conviction to act on it. To understand why Buffett can act so decisively while others are paralyzed by fear, we need to dissect the two most powerful psychological forces at play during a market crash: loss aversion and herd behavior. Loss aversion is a cornerstone of behavioral finance, first identified by psychologists Daniel Kahneman and Amos Tversky. Through a series of experiments, they discovered that for the human brain, the pain of losing is approximately twice as powerful as the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This is a profound evolutionary adaptation. For our ancient ancestors, losing their food supply was a far bigger deal than finding a bit of extra food. A loss could mean death, while a gain was just a bonus. This deep-seated bias has massive implications for investing. When the market starts to fall, your portfolio balance shrinks. The pain you feel is not just a gentle disappointment. It's a visceral, acute psychological wound. Your brain's loss aversion circuitry lights up, screaming at you to make the pain stop. And the quickest way to make the pain stop is to sell. Selling crystallizes the loss, yes, but it ends the uncertainty and the fear of further losses. It's a deeply irrational act driven by an ancient, rational survival instinct. Now combine this with the second force, herd behavior, also known as social proof. We are social creatures. For millennia, our survival depended on sticking with the tribe. If everyone in your tribe suddenly started running, you didn't stop to ask why. You ran too. The one who stayed behind probably got eaten by a saber-toothed tiger. This instinct is still powerfully embedded in our brains. During a stock market crash, the herd is selling. Your friends, your colleagues, the experts on TV, everyone is running for the exits. Your brain's social proof module goes into overdrive. It tells you, if everyone is selling, they must know something you don't. It is safer to be wrong with the crowd than to be right alone. The combination of these two forces creates a psychological death spiral. Loss aversion provides the initial, painful impetus to sell. Herd behavior confirms that selling is the correct and safe thing to do. It's an almost irresistible cocktail of negative emotion that forces even smart people to make terrible financial decisions. Buffett's genius is not that he doesn't feel these emotions. It's that he has trained himself, through the Mr. Market mental model, to recognize them for what they are: cognitive biases, not reliable signals. He understands that the widespread fear caused by loss aversion and herd behavior is the very thing that creates the irrational prices, the incredible bargains. He has learned to use the market's primal fear as his primary buy signal. He leans into the discomfort, knowing that the moment of maximum panic is also the moment of maximum opportunity. It's one thing to admire Buffett's courage from afar, it's another to build that capacity within yourself. To do that, you need a system, a blueprint, that you can prepare in times of calm, to be executed in times of chaos. This is the panic shopping list mental model, a practical guide for turning a stock market crash from a threat into your personal acquisition strategy. Step 1. Conduct pre-crash research. The worst time to decide what to buy is in the middle of a panic. Your thinking will be clouded by emotion. The work must be done now, during periods of market calm. Your task is to identify a list of 5 to 10 dream companies. These are wonderful businesses with durable competitive advantages, what Buffett calls economic moats, that you would absolutely love to own for the long term if only they were cheaper. Perform deep fundamental analysis on each one. Understand their business model, their management team, their balance sheet, and their growth prospects. This is the core work of value investing. You are becoming an expert on a select group of high-quality assets. Step 2. Set your fire sale price. For each company on your list, you must determine the price at which it would be an absolute bargain. This isn't just a slight discount. This is the price that would make you pound the table with excitement. It might be 40%, 50%, or even 60% below its current market price. This is your strike price. You must write it down. This simple act of writing down a number externalizes the decision. It commits you to a course of action based on logic and analysis, not on fear or greed. This list of companies and their corresponding strike prices is your panic shopping list. Step 3. Accumulate your dry powder. A shopping list is useless without money. While the market is calm or even euphoric, you must systematically build a cash reserve. This is your opportunity fund. For a retail investor, this might mean allocating a certain percentage of your monthly savings not into the market, but into a boring, safe, high-yield savings account. This will feel wrong. It will feel like you're missing out on gains, but you must reframe it. This cash is not idle. It is a strategic asset. It is your panic fuel, your ammunition. You are sacrificing small, immediate gains for the potential of enormous, game-changing future gains. Step 4. Execute without emotion. This is the moment of truth. The market finally cracks. Fear is rampant. Your shopping list companies start to tumble. As they hit the predetermined strike prices you wrote down months or years ago, your job is not to think. It is not to second guess. It is not to wonder if it could go lower. Your job is to execute the plan. You take your dry powder and you start buying. Because the emotional decision was already made, long ago, in a state of cold, hard logic. This systematic approach is the ultimate antidote to the psychological pressures of a crash. It provides a clear plan of action, removing the need for emotional decision-making when you are most vulnerable to it. It transforms you from a passenger on a terrifying roller coaster into the operator of a powerful financial vehicle, ready to capitalize on the very fear that paralyzes everyone else. This is how you prepare for the next stock market crash and turn it into a cornerstone of your portfolio growth. Now let's explore the antithesis, the disastrous path taken by the 99% during a market panic. They fall victim to one of two ruinous behaviors: trying to catch the falling knife, or the more common and far more destructive act of capitulation. Catching a falling knife is the attempt by amateur traders to perfectly time the bottom. They see a stock fall 20% and they buy, thinking they've got a bargain. Then it falls another 20%. They might buy more, averaging down. Then it falls another 20%. They quickly run out of capital and are left holding a massive underwater position, their confidence shattered. They failed to realize that in a true panic, irrationality can push prices far below any reasonable valuation for an extended period. But as damaging as that is, the more common story is that of capitulation. This is the final, soul-crushing act of giving up. Let's follow the emotional journey. An investor holds a portfolio of good stocks. The market starts to decline. At first, they are in denial. It's just a healthy correction, they tell themselves. As the decline steepens, denial turns to anxiety. They start checking their portfolio multiple times a day. Anxiety then festers into fear as they see a substantial portion of their life savings evaporate on screen. Finally, fear gives way to sheer, unadulterated panic. They see headlines about recession, they imagine losing their job, they picture their retirement dreams going up in smoke. At this point, their rational brain has completely shut down. The only goal is to make the pain stop. They sell everything. They go to cash. This moment, known on Wall Street as capitulation, is the point of maximum pessimism. And ironically, it is almost always the point just before the market begins to turn around. The investor feels a wave of relief, but they have just made the single worst financial decision of their lives. They have sold their best assets at the worst possible price. Now, a new psychological trap is set. The market starts to recover. At first, they stay in cash, paralyzed. They are convinced it's a dead cat bounce, a false dawn. The market climbs 10% off the lows. It's too risky to get back in, they think. It climbs 20%. I've already missed the easy gains. They rationalize. It climbs 30%, then 40%. Now, a new emotion takes over, the fear of missing out. The same herd behavior that drove them to sell in a panic now pressures them to buy back in. They finally jump back into the market, but at prices significantly higher than where they sold. They have successfully executed the perfect anti-investing strategy. They bought high, sold low, and then bought high again. This emotional roller coaster is why the average investor's returns consistently and dramatically underperform the market itself. They are their own worst enemy, perpetually whipsawed by fear and greed, all because they lack a framework for dealing with Mr. Market's depressive episodes. The financial connection between Buffett's panic principle and long-term wealth creation is profound, and it centers on a concept that is the very heart of value investing, the margin of safety. Benjamin Graham defined it as a favorable difference between price on the one hand and indicated or appraised value on the other. A market crash is a gift from Mr. Market that allows you to acquire assets with a margin of safety that is not just favorable, but colossal. Let's use a tangible example. Imagine a great company, let's call it Quality Company, with a well-established brand and consistent earnings. In a normal market, after your thorough analysis, you calculate its intrinsic value to be $100 per share. Mr. Market is offering it to you for $90. Buying at this price gives you a 10% margin of safety. If you are slightly wrong in your calculations, or if the company faces a minor headwind, you are still likely to do okay. This is sound investing. Now, a panic hits the market. Fear is rampant. Investors are selling everything indiscriminately. Mr. Market, in a fit of despair, now offers you shares of quality company for just $40 per share. Your margin of safety is no longer 10%. It is now 60%. The financial implications of this are staggering. First, it provides immense downside protection. At a price of $40, the business doesn't just have to meet your expectations for you to make money. The business can actively underperform. Its growth can slow. It can face unexpected challenges. And you still have a very high probability of achieving a satisfactory, or even spectacular, return. The risk of permanent capital loss, the investor's cardinal sin, has been dramatically reduced. Second, it creates explosive upside potential. When sanity eventually returns to the market, and it always does, the stock price will not just recover, it will gravitate back toward its intrinsic value of $100. From a purchase price of $40, a return to $100 represents a 150% gain. Compare that to the modest 11% gain from buying at $90 and seeing it go to $100. By acting when others were fearful, you have fundamentally altered your long-term return trajectory. This isn't just about stock picking, it's about structuring your portfolio for maximum asymmetric returns, low risk and high potential reward. This is how professional wealth management firms build dynastic wealth. They don't chase fads. They wait patiently for panics, for moments when Mr. Market offers them the crown jewels for the price of scrap metal. By internalizing the panic principle and using a systematic approach like the panic shopping list, a retail investor can replicate this exact strategy, turning the market's greatest fear into their personal engine for portfolio growth and financial freedom. We have explored Mr. Market in his darkest depths, but our manic-depressive partner has another side to his personality. It's the side that emerges after the fear has subsided, when the skies are clear and the future looks boundlessly bright. This is his euphoric mania, a state of irrational exuberance that is, in many ways, even more dangerous to your wealth than a panic. Resisting the siren song of a raging bull market, the temptation to join the delirious party is one of the hardest disciplines in investing. This is the euphoria trap, and Warren Buffett's masterclass in avoiding it came during the single greatest speculative bubble of our lifetime, the dot-com bubble of the late 1990s. As the new millennium approached, the world was gripped by a frenzy. The internet was a transformative technology, and investors believed it had rendered all old rules of valuation obsolete. Companies with no profits, no revenues, and sometimes no coherent business plan were being valued in the billions of dollars. Words like eyeballs and network effects replaced boring old metrics like earnings and cash flow. It was a classic Mr. Market mania. And amid this nationwide party, Warren Buffett was the ghost at the feast. He famously refused to buy the high-flying tech stocks. Berkshire Hathaway's portfolio was full of old economy stalwarts, Coca-Cola, Gillette, the Washington Post Company. As the Nasdaq soared, doubling and then doubling again, Buffett looked like a relic. He was openly mocked. A now infamous cover of Barron's in 1999 featured the headline, "Warren, What's Wrong?" The article suggested he was too old, out of touch, a dinosaur who simply didn't get the new digital world. The pressure on him was immense. Berkshire Hathaway's stock was dramatically underperforming the market. Shareholders were complaining. Pundits were writing his investment obituary. Yet Buffett did not budge. His anchor was his unwavering commitment to a core principle. Never invest in a business you cannot understand and cannot value. He couldn't confidently project the cash flows of these new tech companies in 5 or 10 years, so he simply didn't play. His most public statement on the matter came at the 1999 Allen & Company conference in Sun Valley, the glitzy annual gathering of media and tech moguls. Instead of defending his performance, he gave a history lesson. He detailed previous speculative manias, from the canal craze of the 1800s to the airline boom of the 20th century, showing how transformative technologies rarely translate into great long-term profits for investors because of intense competition and the flood of capital. He wasn't predicting a crash, he was simply stating that the odds were stacked against long-term success at the current valuations. Then came the reckoning. In March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a brutal, soul-crushing decline. Over the next 2 years, it would lose nearly 80% of its value. An estimated $5 trillion in market value vaporized. Companies like Pets.com and Webvan, once darlings of the new economy, went bankrupt. The wealth of a generation of euphoric investors was decimated. And Berkshire Hathaway? Its boring, profitable, old economy companies held their value. Buffett was no longer a dinosaur, he was an oracle. By having the discipline to ignore Mr. Market's euphoric screams, by resisting the immense social pressure to join the party, he had not only preserved his company's capital, he had positioned it to thrive in the aftermath. The euphoria trap had sprung, and he was one of the few who hadn't taken the bait. The psychological forces that create a bubble are the mirror image of those that create a crash. The primary driver is a potent cocktail of overconfidence bias and the fear of missing out, or FOMO. Overconfidence bias takes root when a rising market makes everyone feel like a genius. An investor buys a stock, it goes up, and they attribute the success to their own skill and insight, rather than to the simple fact that a roaring bull market is lifting all boats. This initial success breeds more confidence, leading them to take bigger and bigger risks. They abandon conservative strategies and start believing they have a special ability to pick winners. They are no longer investing, they are gambling, but they are psychologically incapable of seeing it that way. This individual overconfidence is then supercharged by the social force of FOMO. This is the intense, anxious feeling that everyone else is getting rich without you. You see your neighbor, who knows nothing about investing, bragging about the killing they're making on some hot tech stock. You read stories in the media about 25-year-old dot-com millionaires. The pressure becomes unbearable. Your rational brain, which might be screaming that prices are insane, is drowned out by the primal fear of being left behind. Herd behavior kicks in, just as it does in a crash, but in reverse. Everyone is buying, so you feel compelled to buy too. This creates a self-reinforcing feedback loop. FOMO drives buying, which pushes prices higher, which generates more stories of instant wealth, which creates even more FOMO. It's a psychological vortex. The story of "this time is different" becomes the national anthem. People convince themselves that some new technology or economic paradigm has permanently suspended the laws of financial gravity. Valuation metrics that have worked for a century are dismissed as obsolete. Anyone who expresses caution like Buffett is branded a fool. Buffett's defense against this onslaught is a deep, ingrained skepticism and a fierce intellectual independence. He understands that the desire to believe in easy money is one of the most powerful and dangerous forces in human nature. He insulates himself from the noise. He doesn't watch financial television, he reads annual reports and thinks. He relies on his own analysis, his own internal scorecard, not the roaring approval of the crowd. He has cultivated the ability to be comfortable being the only sober person at a wild party, knowing that while it's not much fun in the short term, he'll be the one without a hangover in the morning. This psychological fortitude to resist the pull of social proof and overconfidence is just as critical to long-term investing success as the courage to buy in a panic. How can a retail investor develop this kind of discipline? How do you stay grounded when Mr. Market is shouting from the rooftops and showering everyone with confetti? You need an anchor to reality. This is the valuation anchor mental model, a system for preventing irrational exuberance from hijacking your portfolio. Step 1. Calculate a baseline intrinsic value. This is the same work you do for your panic shopping list, but it serves a different purpose here. Before you ever buy a stock, and as a regular checkup for the stocks you own, you must establish a conservative, rational estimate of the underlying business's true worth. This is your anchor. It should be based on durable metrics like discounted cash flows, owner earnings, or other fundamental measures. This number, derived from business reality, is your objective truth in a world of subjective market sentiment. Step 2. Define your no-touch premium. Once you have your anchor, you must decide on the valuation ceiling above which you will not operate. This is your line in the sand. For example, you might decide, I believe this business is worth $100 per share. I will not buy any more shares if Mr. Market is offering them for more than $120. Or, using a metric-based rule, I will not buy this stock if it trades at more than 25 times free cash flow, regardless of how optimistic the story sounds. This rule must be established in advance, during a time of calm. It is a promise you make to your future, more emotional self. Step 3. Embrace the inaction mandate. When the market goes into a euphoric phase and your beloved stocks soar past your no-touch premium, your default, pre-programmed action is to do nothing. You do not buy more. You do not get swept up in the excitement. You simply sit on your hands. This is far harder than it sounds. The temptation to add to a winning position is immense, but your valuation anchor and your predefined rule provide the discipline. You watch the party from the sidelines, content with the gains you've already made, knowing that buying at these elevated prices offers a poor margin of safety and a high risk of future loss. Step 4. Implement a trimming rule, optional for advanced investors. If a single stock, due to a massive price run-up, becomes a dangerously large percentage of your portfolio, say over 20%, you can consider trimming the position. This does not mean selling the entire holding. It means selling just enough to bring the position back to its original target weight. This allows you to realize some of the mania profits while still retaining your ownership stake in a great business for the long term. This systematic approach, anchor, ceiling, inaction, provides a robust defense against the psychological temptations of a bull market. It forces you to adhere to a business-like logic, buying based on value, not on price momentum or social pressure. It's the operational manual for being greedy when others are fearful, and fearful when others are greedy. The path of the 99% during a market mania is a well-worn road paved with the 4 most dangerous words in investing. This time is different. They wholeheartedly embrace the seductive narrative that a new technology, a new business model, or a new economic reality has rendered old-fashioned valuation metrics obsolete. They abandon the hard work of fundamental analysis in favor of chasing a story. The psychology is intoxicating. They see prices of speculative assets doubling and tripling. They don't want to miss the ride. They begin to engage in what's known as greater fool theory. They know, perhaps on some subconscious level, that the price they are paying is irrational. But they believe they will be able to sell it to an even greater fool at an even higher price before the music stops. They become obsessed with momentum. They look at charts and graphs, not balance sheets. They are no longer investing in businesses, they are trading tickers. The company itself becomes irrelevant. The only thing that matters is that the price is going up. This mindset leads them to buy things they fundamentally do not understand. In the dot-com bubble, people poured their life savings into companies with .com in their name, with no clue as to how the business would ever turn a profit. They were buying a story, a dream of effortless wealth. The social pressure reinforces this behavior. In a bubble, everyone you know seems to be getting rich. To be cautious is to be a pariah, a wet blanket. The few who do raise questions about insane valuations are shouted down and ridiculed, just as Buffett was. This creates an echo chamber of euphoria. The 99% become the fuel for the final, most dangerous stage of the bubble. They are the ones who pile in at the absolute top, full of confidence and dreams of glory. Their frantic buying provides the liquidity that allows the smart money, the early investors, and the insiders to quietly cash out. They are, in the end, left holding the bag. When the bubble inevitably bursts, their wealth is annihilated, not because they were unintelligent, but because they allowed the powerful psychology of euphoria and social pressure to overwhelm their rational judgment. They wanted to believe in the fairy tale, and they paid the ultimate financial price for it. The direct financial connection of avoiding the euphoria trap is arguably the most important principle in all of investing, the preservation of capital. Warren Buffett's first rule of investing is never lose money. His second rule is never forget rule number 1. This isn't just a clever aphorism, it's a profound mathematical truth. The math of losses is brutal and unforgiving. Let's say you invest $100,000 and get caught in a speculative bubble that bursts, causing you to lose 50% of your capital. Your portfolio is now worth $50,000. To get back to your starting point of $100,000, you don't need to make a 50% gain. You need to make a 100% gain on your remaining capital. A single 50% loss requires a subsequent 100% gain just to break even. Now consider an even more severe loss, like the 80% decline many tech investors experienced after the dot-com bust. A $100,000 portfolio becomes $20,000. To get back to even, that $20,000 must increase by 400%. The damage is almost insurmountable. By sidestepping the dot-com bubble, Buffett didn't just avoid a loss, he preserved Berkshire Hathaway's massive capital base. While other investors and funds were wiped out or spent the next decade just trying to get back to even, Berkshire had a mountain of cash ready to deploy into the wreckage of the bust. This is the ultimate financial advantage. Avoiding large losses is more powerful than achieving large gains. It keeps the inexorable power of compounding working for you rather than against you. A portfolio that can achieve a steady, boring 8% a year without suffering a catastrophic drawdown will, over the long term, annihilate a portfolio that swings wildly between plus 50% gains and minus 50% losses. The investor who avoids the euphoria trap ensures their financial journey is a steady climb up the mountain, rather than a series of thrilling ascents followed by terrifying falls off a cliff. This principle of capital preservation is the bedrock of any serious wealth management strategy. It transforms your portfolio from a speculative vehicle into a resilient, all-weather compounding machine, relentlessly working towards your goal of financial freedom. To truly cement the Mr. Market mindset and make it immune to both panic and euphoria, we must go one level deeper. We must adopt the fundamental perspective that underpins Buffett's entire philosophy. This is the business owner's edict. You must learn to see stocks not as blinking tickers on a screen, but as fractional ownership stakes in real, living, breathing businesses. This shift in perception is the ultimate source of emotional stability. There is no story that illustrates this principle more perfectly than Buffett's acquisition of See's Candies in 1972. At the time, Berkshire Hathaway was still primarily a textile company. Buffett and his partner, Charlie Munger, were looking to deploy capital into better businesses. Through a contact, they were introduced to the See family, who were looking to sell their iconic California-based candy company. From the very beginning, Buffett's approach was not that of a stock picker. It was that of a private business buyer. He and Munger didn't look at a stock chart. There was none. They didn't analyze trading volumes. Instead, they traveled to California. They visited the stores. They talked to the managers. They tasted the candy. They were analyzing the business itself. What they found was a commercial jewel. See's had a fanatically loyal customer base. People who grew up with See's at Christmas and Easter would continue buying it their whole lives and pass the tradition on to their children. This fierce brand loyalty gave the company tremendous pricing power. They could raise prices a little bit each year to account for inflation, and their customers wouldn't even blink. It was a simple, understandable business that gushed cash. The See family was asking for $30 million. Buffett, after running the numbers, thought it was worth only $25 million. The deal almost fell apart over that $5 million difference. Buffett, still deeply conditioned by his early cigar-butt investing style of buying dirt-cheap, statistically undervalued companies, was hesitant to pay up for quality. It was Charlie Munger who pushed him. Munger argued that they weren't just buying assets and earnings, they were buying an intangible, a powerful brand, an economic moat that would protect the business for decades to come. Buffett finally agreed to the $25 million price they negotiated. That decision would change the course of Berkshire Hathaway forever. See's Candies became the prototype. It taught Buffett the immense value of paying a fair price for a wonderful business, rather than a wonderful price for a fair business. Since 1972, See's has generated over $2 billion in pre-tax earnings for Berkshire, capital that Buffett was able to reinvest into other wonderful businesses. He never once thought about selling his stake in See's based on a bad economic forecast or a market downturn. Why would he? He was an owner of a fantastic candy company. The daily mood of Mr. Market was completely irrelevant. This is the mindset we must cultivate. The reason the business owner's edict is so psychologically powerful is that it provides a direct antidote to two insidious cognitive biases that plague the stock market: the abstraction fallacy and salience bias. The entire ecosystem of modern finance is designed to make you forget you are buying a piece of a business. It's an ecosystem of abstraction. You're not buying a share of Apple, the company that designs, makes, and sells beloved consumer electronics to billions of people. You're buying AAPL, a four-letter symbol. You're not analyzing its competitive position. You're looking at its 50-day moving average. This is the abstraction fallacy. By reducing a complex, tangible business to an abstract ticker, it becomes emotionally much easier to treat it like a meaningless gambling chip. It's hard to imagine panic selling your local pizza place that you know is profitable and packed every night. But it's incredibly easy to panic sell PZZA when the ticker turns red. The business owner mindset shatters this abstraction. It forces you to connect with the tangible reality of the company. Hand in hand with this is salience bias. This is our tendency to focus on things that are prominent, noticeable, and easily perceived, while ignoring things that are less obvious but potentially more important. In the stock market, what is the most salient piece of information? The price. It's constantly changing, it's displayed in bright colors, it's the subject of all financial news. The price screams for your attention. What is less salient? The company's slowly growing market share, its prudent capital allocation, its rising return on equity. These are the fundamental drivers of long-term value, but they move slowly and are hidden away in boring financial reports. The average investor, a victim of salience bias, fixates on the price. Their entire analysis and emotional state are dictated by this single, noisy, and often misleading data point. The business owner, by contrast, forces their attention onto the fundamentals. They understand that the stock price is just Mr. Market's opinion, while the underlying cash flow is a business fact. By consciously shifting their focus from the salient price to the important fundamentals, they insulate themselves from the market's emotional volatility. They stop being a price watcher and become a business analyst. This transformation is the final and most crucial step in conquering fear and greed. So how do we operationalize this mindset? How do we force ourselves to think like a business owner every time we consider an investment? We use a mental model I call the "Would I own the whole thing?" gauntlet. It's a series of 5 questions you must run every potential investment through before you ever click the buy button. Question 1. The private purchase test. Ask yourself, if I had the money, would I buy this entire company, take it private, and own 100% of it tomorrow? This is a powerful framing question. It forces you to think beyond the stock and consider the responsibilities and realities of ownership. If your answer is anything less than an enthusiastic yes, you should probably pass. Question 2. The 10-year test. Can you, in simple, jargon-free language, explain how this business is likely to be making significantly more money in 10 years than it is today? This is not about building a complex financial model. It's about understanding the long-term strategic direction and competitive landscape. If you can't articulate a clear path to future growth, you are speculating, not investing. Question 3. The CEO test. Read the last few years of shareholder letters. Watch interviews with the CEO. Ask yourself, do I trust this person and their executive team to be good stewards of my capital? Do they think and act like long-term owners? Or are they focused on short-term stock price performance? You are, in effect, hiring this management team to run your business for you. You would never hire someone you didn't trust. Question 4. The moat test. What is this company's durable competitive advantage? What prevents a smart, well-funded competitor from coming in and destroying their profits? Is it a powerful brand like Coca-Cola? A network effect like Facebook? A low-cost process like Geico? If you cannot clearly identify a strong and lasting economic moat, the business is vulnerable. Question 5. The price test. Based on your answers to the first 4 questions, what price would you, as a prudent business person, be willing to pay for this entire enterprise? This isn't about where the stock traded yesterday. It's about what you believe the business is fundamentally worth. That number becomes your target purchase price, the price you will wait for Mr. Market to offer you. Running every investment through this 5-question gauntlet transforms your entire decision-making process. It slows you down. It forces deep thinking. It shifts your perspective from that of a short-term trader to that of a long-term capital allocator. It's a foundational process for any retail investor who is serious about stock picking and building lasting wealth. The antithesis to the business owner's edict is the dominant mindset of the modern market, the day trader mentality. The individual operating with this mindset does not see businesses at all. They see a screen full of digital confetti, pieces of data to be manipulated for short-term profit. Their world is one of technical analysis, not fundamental analysis. They are obsessed with chart patterns, trading volumes, and momentum indicators. They speak a language of head and shoulders tops, golden crosses, and Fibonacci retracements. They could not tell you what the company they are trading actually does, who its customers are, or how it generates cash. They don't care. To them, the stock is completely divorced from the business. It is an abstract entity with a life of its own, to be ridden up and down for quick gains. This mindset makes them exquisitely vulnerable to Mr. Market's every whim. Because the price is the only reality they recognize, they are completely at the mercy of its movements. They have no anchor to business value to hold on to when the seas get rough. A piece of bad news, a sudden market downturn, and they are instantly flushed out of their positions, because their positions were never based on any long-term conviction in the first place. They are renting stocks, not owning businesses. They are also fighting a battle they are almost certain to lose. They are competing against high-frequency trading firms with supercomputers co-located next to the exchange's servers, executing millions of trades in the blink of an eye. They are competing against hedge funds with armies of PhDs and access to information they can only dream of. The day trader mentality is the ultimate expression of hubris for the retail investor, an attempt to win a game that is rigged against them through speed and information, rather than playing the one game where they have a distinct advantage: time. This constant churning, this frantic activity, gives them the illusion of control, but in reality it is a surefire path to underperformance and financial frustration. The direct financial connection of adopting the business owner's edict is the harnessing of the most powerful force in the financial universe, the power of compounding quality. When you buy a piece of a truly wonderful business, one with a strong economic moat, excellent management, and bright long-term prospects, and you hold on to it, you are not just waiting for the stock price to go up. You have plugged your capital directly into a wealth creation machine. 2 powerful compounding engines are now working for you simultaneously. The first engine is internal to the business. A great business generates high returns on the capital it employs. It takes its profits and reinvests them back into the business in new projects, new products, or acquisitions that also generate high returns. This process, repeated year after year, causes the intrinsic value of the business itself to grow. The business becomes more valuable every day, completely independent of its stock price. The second engine is external, within your portfolio. By holding onto your shares and not trading in and out, you allow that internal business compounding to translate into an exponential growth curve for your investment. You are letting your winners run. You allow the value of your stake to grow tax-deferred year after year. This is the critical difference between the linear gains of a trader and the exponential gains of a long-term owner. A trader might make 10% on a trade, then another 10% on the next. An owner might see their investment grow by 15% per year, but that 15% is on a constantly growing base. After 20 years, the difference is not small, it is astronomical. This is the engine of true financial freedom. It's not about finding the next hot stock tip. It's about identifying a handful of truly exceptional businesses and then having the discipline and the business owner's mindset to hold on to them for decades, letting the magic of compounding do the heavy lifting for you. It is the most reliable path to building not just wealth but generational wealth. We have now assembled the core components of the Buffett Munger approach to the market. We have the Mr. Market allegory to manage our emotions. We have the panic principle to capitalize on fear and the discipline to avoid the euphoria trap. And we have the business owner's edict to anchor us to fundamental reality. But there is one final piece of the puzzle, one overarching principle that binds all the others together and provides the ultimate, unfair advantage in a world obsessed with speed. This is the principle of patience arbitrage. In a financial system dominated by high-frequency traders, quarterly earnings reports, and a 24/7 news cycle demanding instant analysis and action, the simple act of being patient has become a profound competitive advantage. Warren Buffett's single greatest investment, the one that perfectly embodies this entire philosophy, is his purchase and long-term holding of the Coca-Cola Company. The story begins in the wake of the Black Monday stock market crash of October 19, 1987, when the Dow Jones Industrial Average fell a staggering 22.6% in a single day. Mr. Market was in a state of absolute terror. In the months that followed, Buffett, who had been sitting on a pile of cash, saw his opportunity. He began to aggressively buy shares of Coca-Cola. At the time, Coke was seen as a boring, mature, old economy company. Its stock had been flat for years. But Buffett wasn't looking at the stock chart. He was looking at the business. He saw one of the most powerful brands in human history. He saw a simple, predictable business that sold a low-cost, habit-forming product in every corner of the globe. He saw a company with enormous growth potential as it expanded into emerging markets. He saw, in essence, a commercial fortress. In 1988, he invested over $1 billion into Coca-Cola, acquiring a stake of around 7% of the company. It was a massive bet for Berkshire Hathaway at the time. And then, he did the most radical thing imaginable in the world of modern finance. He did almost nothing. He sat. For years. For decades. He didn't sell when there was a bad quarter. He didn't sell when a new competitor emerged. He didn't sell when the economy went into recession. He simply held his ownership stake in this wonderful business, collected the steadily growing dividends, and let the company's global expansion and the power of compounding work their magic. That original $1.3 billion investment is now worth well over $20 billion, and it has paid Berkshire billions upon billions in dividends over the years. This legendary investment was not the result of a brilliant trade or a complex insight. It was the result of a simple insight into business quality, combined with an almost superhuman level of patience. Buffett was arbitraging time itself. The psychological reason that patience is such a powerful and rare advantage is a cognitive bias known as hyperbolic discounting, or more simply, present bias. This is our brain's powerful, innate preference for immediate gratification over a larger, delayed reward. If I offer you $100 today or $110 in a week, most people will take the $100 today, even though a 10% return in 1 week is an astronomical, annualized gain. Our brains are wired for the short term. The promise of a future reward feels abstract and uncertain, while the pleasure of a present reward is concrete and real. The entire modern financial industry is built to exploit this bias. Everything is designed to make you act times now. The constant stream of breaking news, the real-time price quotes, the buy and sell ratings from analysts, the mobile trading apps that make executing a trade as easy as ordering a pizza. It's all a massive infrastructure of impatience. It creates an overwhelming action bias, the feeling that you must constantly be doing something to be a successful investor. This environment is poison for long-term thinking. Warren Buffett's entire operational philosophy is a rebellion against this. He has structured his life and his company to maximize his ability to be patient. He lives in Omaha, Nebraska, far from the frenetic noise of Wall Street. He spends most of his day reading and thinking, not watching a stock screen. His favorite holding period, he jokes, is forever. He is exploiting the fact that most other market participants, from hedge fund managers judged on quarterly performance to retail investors addicted to the dopamine hit of a winning trade, are psychologically and structurally incapable of being truly long-term. He is playing a different game, on a different time horizon. This is patience arbitrage, capitalizing on the market's obsession with the next quarter to focus on the next decade. He is willing to wait for a payoff that others simply cannot endure waiting for, and this gives him an edge that no amount of computing power or short-term information can overcome. How can an ordinary retail investor cultivate this kind of profound patience in a world that demands instant results? You need to consciously design an environment and a set of rules that favor long-term thinking. This is the coffee card system for long-term investing, a mental model designed to enforce discipline and expand your time horizon. The first element is the punch card mentality. Buffett once said that a great way to improve your investment results would be to imagine you have a punch card with only 20 slots on it. Each time you make an investment decision in your life, you punch a hole. Once you've used all 20 punches, you can't make any more decisions. This simple visualization is incredibly powerful. It immediately raises the bar for what qualifies as a worthy investment. You would stop making frivolous trades. You would stop speculating on fads. You would conduct incredibly deep research and wait for a truly exceptional opportunity before you were willing to use one of your precious punches. Second is the 5-year default. When you buy a stock, using the business owner's gauntlet, make a solemn, written commitment to yourself that you will not even consider selling it for at least 5 years. The only exception is if the fundamental story of the business dramatically deteriorates. This is not a hard and fast rule, but a default setting for your brain. It short-circuits the temptation to sell based on short-term market noise or price fluctuations. Third, you must automate and forget. The best way to resist temptation is to remove it. Set up automatic, recurring investments into your chosen companies or low-cost index funds. Let your portfolio build itself systematically, in the background. Then, critically, increase the friction of making impulsive decisions. Delete the brokerage app from your phone's home screen. Unsubscribe from market newsletters. Turn off the financial news. The less you look, the less you will be tempted to act. Finally, schedule an annual review. Instead of daily or weekly monitoring, which encourages short-term thinking, calendar one day per year to conduct a high-level review of your portfolio. This is your time to be a CEO, to check if your holdings are still aligned with your long-term goals and if the fundamental theses are still intact. This transforms your portfolio management from a constant, emotional, reactive process into a calm, rational, and strategic annual event. This system is designed to combat present bias and action bias by building a structure of disciplined patience into your financial life. The antithesis of patience arbitrage is the path the 99% follow, driven by the insidious action bias. This is the deeply ingrained belief that activity equals progress. They feel that to be a good investor, they must be constantly engaged, reading the news, watching the charts, buying, selling, rebalancing. Sitting on your hands and doing nothing feels lazy, irresponsible, and passive. Wall Street loves this bias. The more you trade, the more commissions and fees you generate for your broker. The more you churn your portfolio, the more you contribute to the liquidity that sophisticated players use to their advantage. The financial media also fuels this bias, because their business model depends on convincing you that you need to pay attention to the news every single minute of every single day. The consequences of this constant activity are financially devastating. First, there are the direct costs. Trading commissions, though lower than they used to be, still add up. More significant is the bid-ask spread, the small difference between the buying and selling price of a stock, which is a hidden cost on every single trade. Over a lifetime of frequent trading, these frictional costs can eat up a substantial portion of your returns. But the most significant cost is taxes. When you sell a stock that you've held for less than a year at a profit, that gain is taxed as short-term capital gains, which is taxed at your ordinary income tax rate, the highest rate you pay. If you simply hold that same stock for more than a year, your gain is taxed at the much lower long-term capital gains rate. The difference is enormous. The hyperactive trader is essentially giving a huge chunk of their profits back to the government, a self-inflicted wound born of impatience. They are so focused on generating small pre-tax gains that they fail to see the massive post-tax wealth they are destroying. They mistake the motion of the hamster wheel for forward momentum, all the while enriching the brokers, the market makers, and the taxman at their own expense. This brings us to the final and perhaps most tangible financial connection, the massive, quantifiable advantage of tax efficiency and the reduction of frictional costs. This is the patience bonus that accrues to the long-term investor. Let's put some hard numbers on it. Imagine two investors, Active Alice and Patient Paul. Both start with $100,000 and are skilled enough to generate a 12% pre-tax return each year. Active Alice trades frequently. All of her gains are short-term. Let's assume she is in a 32% federal income tax bracket. Each year, her $12,000 gain is taxed at 32%, so she pays $3,840 in taxes. Her true after-tax return is only 8.16%. Patient Paul also generates a 12% return, but he achieves it by buying and holding. He doesn't sell, so he pays no capital gains tax during the growth phase. He allows his full pre-tax returns to compound year after year. After 30 years, Active Alice's portfolio, despite her 12% pre-tax skill, will have grown to about $1,035,000. Not bad. But Patient Paul, who let his capital compound tax deferred, would have a portfolio worth over $2.99 million. When he finally sells, he'll pay the much lower long-term capital gains tax, let's say 15%, leaving him with over $2.5 million. Paul's patient strategy resulted in a net worth nearly 2.5 times larger than Alice's, even though they had the exact same investing skill. His secret weapon was patience, which allowed him to minimize taxes and frictional costs. This is not a small optimization. It is a game-changing structural advantage. The ability to let your capital compound without the constant drag of taxes and fees is one of the most powerful and overlooked engines of wealth creation available to the retail investor. It transforms long-term investing from a good idea into a mathematical imperative. It is the final, powerful financial reward for adopting the full Buffett Munger mindset, a mindset that is rational, business-focused, and above all, incredibly patient. You have just been given a powerful weapon. This framework, built around the simple story of Mr. Market, is more than just an investing strategy. It is a complete psychological operating system for navigating the chaos of the financial world. You now possess the mental model to see market volatility not as a threat, but as an opportunity. You have the blueprint to remain rational when others are panicking, and to be skeptical when others are euphoric. You understand that you are not buying tickers, you are buying businesses, and you recognize that in a world obsessed with speed, patience is your ultimate unfair advantage. This tool, if you internalize it and apply it with discipline, has the power to fundamentally alter your financial destiny. But mastering your own psychology is only half the battle. This entire system is predicated on one critical assumption, that you know what to buy when Mr. Market offers you a bargain. It's one thing to have the courage to run into a burning building. It's another thing entirely to know which items inside are priceless artifacts and which will turn to ash. Warren Buffett's genius is not just that he buys when there is blood in the streets. It's that he knows exactly which high-quality fortress-like businesses to buy at those moments. The Mr. Market framework tells you time when to act. But there is another interconnected set of mental models that tells you time what to act on. The video that is now appearing on your screen is the next piece of that map. Think of the Mr. Market model as the key that unlocks the door to opportunity. The principles in this next video are the flashlight you need to find the treasure inside the room. It is the link that connects market psychology to business analysis. It is the bridge from understanding the mood of the market to understanding the quality of a company. To end your journey here is to learn how to open the door but to be left standing in the dark. The choice to click is not about watching another video. It is about completing your mental arsenal. It is a choice to graduate from being an investor who can withstand fear to one who can skillfully and confidently identify the world-class assets that will build your fortune. The map is in your hands. Continue the journey.